Hey guys, Rodney Kenner here with Creative Culture, where our purpose is to help business owners maximize the freedom that they feel in running their business. And so today we're going to be talking about the most important thing that you need to understand as a business owner, your financials. We're going to be talking about your P&L statement and how your P&L is not your cash flow statement. Because here's the problem. Financials are the language of business. And if you don't understand the language of business, then you're not going to be able to make great decisions in order to get you the freedom that you want as a business owner. So today we're going to be talking about your P&L statement, what it is, what it's trying to tell you, how you should go ahead and set it up, whether you're a first-time entrepreneur, business owner, or somebody who's been in business for a long time. How do you set this thing up? What is it trying to tell you? And things that you should be aware of as you look at your financials. So the first question that you got to ask yourself is, what is the P&L? And to understand the P&L, I'm going to use some photography and videography examples. When you think about your P&L is a recording. Just like a video recording, there's a certain starting point and a certain stopping point, and throughout that period of recording, it's telling you what happened, what's the scene, what came in, what went out, and how does all of this fit together. And so the way that the P&L should be set up is in your accounting system, you're going to have what's called a chart of accounts. Your chart of accounts is all the accounts or all of the line items within your financial system that you're able to identify what your transactions are and where they should go. Now, in order to set up a very healthy chart of accounts, what I would caution you on is not setting up too many things to where you cannot see the forest for the trees. Here's what I mean by that. If you're going to go to Office Depot and you're going to buy different office supplies, here's what I would not do. Do not come back and tell your accountant, hey, I want a line item on my financial statements for all of the markers that I buy, and then for the pens, and then for paper, and then for X, Y, and Z. No, everything should fit inside of a bucket of just office supplies, because you don't want to open up your P&L and have it be 2 to 3 pages long where you're missing the story of what your P&L is trying to tell you. And so the first thing that I would tell you to do, if you've got too many accounts in your P&L, you open up your P&L and it overwhelms you, it's 2 to 3 pages long, and you're not able to really understand what it's trying to tell you and show you, I would get with your accountant and say, hey, what are the things that we just need to pare down and get rid of, either within our chart of accounts or on the reporting, so I can see this thing maybe just on one page? Because you want to be able to look at your P&L on one page and be able to go, okay, I understand the story that it's trying to tell me. So in order to set up the story of what it's trying to tell you, there are certain ways that the P&L statement should be set up. You're going to have different types of transactions and different things in your P&L. And the two things that you're going to have in your P&L, or the couple things, the few things you're going to have in your P&L, is you're going to have all of your sales. So up at the top, when you look at your P&L, sales should be at the top. You sold a product, you sold a service, that thing should be the very thing up at the top, followed by a section called your cost of sales or your cost of goods sold. So if you're running an operation where you've got goods that you're selling, but there's a cost that you incurred. I'm selling a little widget for $30, but for me to make that widget, it costs me $15. I'm going to have my sales up at the top, followed by the cost of my goods sold. This is going to get me my gross margin after all of my expenses. So sales followed by your cost of goods sold or your cost of sales, and that's going to get you right underneath that. You're going to want to put all of your expenses. So all of your expenses, typically what I recommend people do is, again, go back to a bucket, and you want all of your buckets. You don't want to have too many buckets, maybe 15 to 20 different buckets that helps you understand what's going on in your business at a very high level. and alphabetize those buckets so that they're the same every single time as you look at your P&L statement. So you're going to have your revenue, your cost of sales, followed by all of the operating expenses for your business in order to operate. And at the end, at the bottom of your P&L statement, it's going to show you what's left over after everything has happened inside of your business. Obviously, you want that number to be as large as you can get it, because that shows that you operated your business very efficiently. And so the next thing that you may want to look at in setting up your P&L is what time frame should I be looking at this on? I mentioned earlier that your P&L is like a recording. So you want to start it and stop it over a period of time. And typically you're going to look at that over a month period, or maybe over a quarter, or over the year. But you want to be able for it to tell you a story of what's happening in your business. And so there's different ways that you can set this up. You could have, the first way that you could have it set up is you could just have a month over month comparison, meaning, hey, if today is October 31st of 2026, and I want to look at this comparative to where we were October 31st of 2025, well, then I can look at that and be able to compare each period versus another period. That might be good if you're a seasonal business where some of your business or a majority of your business comes at one moment or one season at a time, and you want to be able to say, hey, how did we do this period over last period? So it set it up to where you've got a year over year comparison for the same month. Another way that you could set it up is for you to be able to analyze the trends that are happening in your business. So you might look at your P&L for the last 3 months, where you're going to have the current month that you're in with the previous 3 months beforehand, so that you can get an idea of, hey, maybe your sales cycle is a little bit longer. You spend a little bit more on marketing or on the cost of sales, and then the sales come through later, and maybe that's how you have it set up, and so or that's how your business runs. And so you want to look at this to be able to look at the picture from not just when you spent all your money on marketing and didn't get any sales from it, but from the time that the marketing expense would have flowed all the way back through to you getting your sales in from that marketing expense. So you could look at it for, hey, the trailing 3 months. I'm going to look at my P&L for the trailing 3 months to see how I've done. Or maybe you're going to look at it from the trailing 6 months or the trailing 12 months, or maybe it's going to be over the last year. And here's what I would recommend. I would recommend that you would have a column for each month. And then right next to the column, just add this little column to every single month, is I want you to put a percentage column. So the percentage column is going to be that line item divided by the revenue from that month. And what you're looking for is you're going to look for the percentage of either revenue or the percentage of spend or the percentage of your net profit during that period of time compared to your revenue. Because what you want to look at, if you're going to do any sort of trend analysis, you're going to want to look for what are the trends, because the numbers may not tell you the story, but the percentages will tell you a more accurate story. What I mean by that is 1 month you might have a spend in utilities that's $5,000, and the next month you might have a spend in utilities that's $8,500. Well, those don't really tell me the story if I don't really understand what percentage of the revenue that I spend on utilities, and whether that's in line with historical activity, or whether or not I should be alarmed by that. And so if there's a variance, if there's a difference there in months where it's maybe in the first month where you spent $5,000, maybe it's 2% of your revenue, but then in a month where you spent $8,500, it's 7%. You're going to want to look at that. That's the trend that you're going to want to pay attention to. But if that $5,000 at 2% and $8,500 is at 2.75%, you're not going to want to look at that, because there's really nothing there that your business is following a trend in order for you to understand, hey, everything is going well. And so we wanted to set up, I'm going to just review real quick. You want your P&L set up top to bottom, revenue up at the top, the cost of your sales right underneath that, followed by all of your operating expenses, which is going to give you your net profit at the end. And then you can look at it horizontally to how do you want this thing set up? Because as I said before, you want your financial statements to be able to tell you a story. And the story ought to be clear in order for you to be able to make good decisions within your business. So here's the last part of this is I just want to talk about some warning statements or some warning things for you and your business. I mentioned earlier, your P&L is not your cash flow statement. Your P&L is not going to match up with the activities that happen within your bank account. Here's why. There are certain expenses that happen within your business that are not P&L items. What? Yes, there are certain expenses that happen within your business that are not P&L items. Here's what I mean by that. If you have debt on your business, every time you pay that debt back, the principal payment for that debt is not found on your P&L. It's found on your balance sheet. And so if you have a $5,000 or a $10,000 or a $20,000 loan payment, a portion of that is going to interest, which is found on your P&L, but another portion of that is going on your balance sheet, paying down the loan. It's not going to tell you the full story. Same thing with any sort of piece of equipment that you buy. If you're looking at evaluating your business and cash flow wise, or maybe you're looking at a business and you're looking to buy it, you're going to want to see the balance sheet because you're going to want to look at, okay, my furnitures, my fixtures, and my equipment, has there been activity there? Has there been spend cash flow going out of the company that would not show up on my P&L statement, but the inventory or the account on the balance sheet is growing larger, and so I'm able to recognize that there are certain things here on the P&L statement that or on the balance sheet that are not reflective within the P&L statement. And then the last thing that you're going to want to be aware of is that you're going to have some balance sheet items. Like I said, if you buy a piece of equipment, that piece of equipment is going to get depreciated over a period of time. And depreciation is a non-cash expense. Depreciation is going to lower the amount of income that you have, but it's not going to impact the amount of cash that you have in your business. And so you want to be able to make sure that you know the ins and outs. Typically what you'll do on a P&L statement, how sophisticated you are, if you've got those certain things that are happening inside of your business, you'll have a section or you'll have a line item that's called EBITDA, EBITDA. That's a common business language that just means earnings before interest, taxes, depreciation, and amortization. And this is essentially showing you what's all the stuff that doesn't go into the real operating of the business. That if you were to strip all the debt away, if you were to strip all of the equipment away, all of that, what are the true earnings of the business? And then what are the other little fluff things, the accounting things that you have to do from a tax and other reporting standards. So as a recap, your P&L, it's not your cash flow statement. Your P&L is a recording. It is telling you from a starting point to a stopping point, typically the first of the month to the end of the month, or the first of the quarter to the end of the quarter, just how well your business turned sales into profit. How it should be set up top to bottom and horizontally, top to bottom, revenue up at the top, your cost of sales next, followed by all of your operating expenses. And it shows you how efficient you were at turning your revenue into profit. And then horizontally, just be able to look at the trends that are happening inside of your business so you know how your business is doing, regardless of what the numbers may do up and down month to month. And just remember, your P&L is not your cash flow statement. There's so many things that happen inside of your business that the transaction will get recorded on your balance sheet. So you got to make sure that you've got a good grasp on all the things that are happening and what they mean for you. Because remember, financials are the language of business. The smarter that you are in this language, the better you'll be as a business owner, the more freedom that you'll have in order to make great decisions, in order to free you up and make your business operate more efficiently. Thanks for your time. Hope you guys found this valuable. And if you ever need anything, please reach out. Like this video, click to subscribe, and we'll see you guys on our next video.